Hello. 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 Did you hear anything? Oh, can you hear me? Um, do you have a? Do you want a holding slide? While the what we can do is we can like switch the. No, we can just completely switch the screen, and I'll just keep running anyway. You can have both. Yeah. 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 Hello. 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 Just turn it off and then put it up. In terms of, because it's meant to be like placed on a desk and it just captures a bit of your voice, but we'll just lower it so it does it to feedback as well. Should be good.
Hello. There's pizzas up by the bar. There's some vegan options. Starting in about 10 minutes. Hey guys, if you want to make your way over, we're going to get started. If there's plenty of seating over here. Can everyone please come over? All right, a couple of quick things. My name's Andrew Malcolm, helping run Auckland Investment Club. So Louis, who runs this space, has asked me to point out a few quick things for health and safety. Anything goes wrong, Louis over there, he'll put his hand up and he'll give us directions. Toilets out the door, past the elevators to the right. Right, so when we started Auckland Investment Club, the whole premise behind it was to bring products and services and ideas to the wider investment community that we believed in. And so we first started with Sam Stubbs because I really believe in the simplicity KiwiSaver product and their vision, and the investment funds as well. And I really trust the way that Sam's running it, and he's setting it up for the future. And when I started thinking about individual shares, you can set up your KiwiSaver, and if you want to do some of your own active investing, you want to pick your own stocks. Sharesies obviously came to mind. It's a popular new platform and is very user friendly. But again, it does have some limitations. And if you want to have access to another platform that is, safe and secure and well regarded in the investment community, then Hatch Invest was a name that just kept popping up. So I'm reluctant to bring other KiwiSaver providers in, and I'm reluctant to bring competing products in because I'm happy to put my name to what I believe to be as the market leader in what they do. And so with Hatch doing things the way they do it, and with the backing of Kiwibank and the fact that you can buy American shares through the platform, Hatch was the name that just kept coming up. And so through my own personal curiosity and wanting to bring Kristen in front of you guys, she was very happy to oblige to come and speak with us. So she's please welcome Kristen.
I'm going to use that. Is that okay? I'll speak loudly. Yeah? Okay. Let's see. Good. Better? Good. Hi, everyone. How are you doing? Thank you so much for coming out. Beautiful weather here in Auckland. I'm up from Wellington. And it's always a pleasure to come. This is our Hatch. This is Hatch's Auckland office, actually, Zero Rewired. So thank you so much to Auckland Investment Club for having us. Thanks so much for Zero Rewired for hosting us. If you're a startup looking for space, this is a fabulous space. And I'm here really to talk to you about the story of Hatch, but I also want to talk about IPOs because 2019 is a pretty sexy year, and I think it's worth mentioning just what's happening in this space and why why it's so interesting. And then if we've got time, chat a little bit about some things that we're learning from our investors, which I hope a few of you are in the audience today. I might pick on a couple of you. Let's see Jeff in the back there. Anyway, as I said, I'm Kristen. I've come from a startup background. A couple of us got together. We were asked by Kiwi Wealth, which is part of the Kiwi Group family, to take a look at really take a look at the future of wealth and what would wealth in the future look like, and how do people want to manage their money and grow their money. And that seems like a really audacious thing to do and to be tasked to do. There were 4 of us at the time. But we set out and we just thought, well, we'll just start small, just like a startup would. We're all from the startup community. And we did. And we got out and we just started talking to investors. And as you know, in financial services and our financial lives, there's so many problems to be solved. It made sense for us to start with investing, Kiwi Wealth being a wealth business, investing business. But some of the really big trends that we saw were self-directed. So people more and more increasingly want to get advice either from their peer group, from their parents, from advisors, but they want to execute themselves. And they want to do that because they can. Information is at hand. Technology has made it low cost. APIs means that the world is accessible to us, even down here in New Zealand. And so that self-directing is on the rise. So we knew our solution had to have something to do with self-directing. And then when we looked around what was available and not available in New Zealand, we started talking to engaged investors, so those that already had started on their investment journeys, and they felt locked out from some really interesting investment opportunities. So we thought, well, let's just start there. So we looked at fractional property, we looked at, all sorts of things. But when we put brands of some really well-known companies in front of people, one of the prototypes we tested, they were grabbing the phones out of our hand and saying, when can we invest? So that was, Tesla, Apple, Amazon, the likes of kind of these really exciting brands that we know we use, maybe not Tesla, maybe some of you do, but I certainly don't, and want to invest in the success of some of these really well-known companies. And so we found a partner in the US to do this, and we looked at business models and we thought, right, Hatch platform. So we've got a really big vision to bring world-class investments into one place so that Kiwi investors can mix and match investments to build wealth their way. And we thought, let's just start with the US share markets because it's exciting. We feel like it's one of the most exciting markets in the world, certainly one of the most liquid, has some of the most exciting companies on it, and Kiwis thus far haven't been able to access these markets and companies very easily. So we thought, let's start there, which we did. So we spent about 16 weeks building the platform. We grew to a team of 7 at the time. This was just over a year ago. And we spent 16 weeks building the platform. We knew it had to be fully digital. We knew we had to comply with both New Zealand AML, anti-money laundering, and all of the regulatory obligations here in New Zealand, but also in the US. So we did that. And then we just wanted to make it like an e-commerce experience, very much like a shopping easy experience. So we did that. We also launched it with very few features and bells and whistles. And that was important to us to actually launch it in its simplest form so that we could launch it to those investors that wanted to get going right away and would forgive us for the lack of features that it had, because it was important for us, and it is important to us, to build this platform with our community. And that's what we continue to do. So we launched about 10 months ago. And people are saying some pretty cool things about us. You can sign up in under 5 minutes. Like I said, everything's digital. You can get watch listing. You can start learning right away, investing in over 2,900 of the world's best known companies. That includes foreign companies that are listed in the US share markets, but also over 500 exchange traded funds. And that's something we haven't really pushed to date, but it's pretty exciting on Hatch. And if I think about some of the more popular exchange traded funds, yes, there's the S&P 500s and some of the primary indexes that you see, but through Hatch, you can really build any strategy you want. So if you want to, invest in gold, we've got exchange traded funds, and silver and real estate, in and investment strategies such as momentum, or we've got some inverse ETFs. We've got leveraged ETFs. We've got ETFs that are exposed to not only commodities, as I mentioned, but emerging markets and different sectors. And so it's something that we'll probably look at. How do we kind of tweak maybe our business model and make those a bit more accessible to Kiwis as well, the exchange traded funds. But some cool stats is that we've got over 33 million has been invested through Hatch. We are part of the Kiwi Group family, so we feel like, yes, we're a startup, but we've got the best of both worlds, that we're backed by a really powerful Kiwi brand. We're actually, co-located inside of the Kiwi Wealth offices. We get to leverage, a lot of their legal and regulatory services, as well, and expertise as well. So it's pretty cool. But we operate very much like a startup. There's 10 of us now, and it's been great. Over 11,000 signups to date, and that 4 is the median number of investments that investors have made. Why'd I put that on there? I don't know, but I just did, because it just shows that anywhere from one investment all the way up to hundreds that investor has made through Hatch, and just goes to show how flexible the platform is and how really varied people come in with investment strategies. They have all different types of investment philosophies and strategies. They're on Hatch for different reasons, but they'll pretty much find what they're looking for to align to what they're doing, which is pretty awesome. Now, I'm here tonight to talk a little bit about IPOs. This is the ugliest picture that I could find, so I thought it was fitting to use. And what it represents is the unicorn. The unicorn is something that Silicon Valley is termed for startups that are privately valued at over $1 billion. Now, it used to be 1 million, and then I remember the year that it was all of a sudden 1 billion. And it's mind-blowing, really, how much these startups are worth. If you're here in Zero Rewired, you're probably a startup, and you're looking to be a unicorn, and you're probably well aware of what's happening in the space. If you're an investor, you're probably well aware of all the companies that are rolling on, particularly this year. 2019 is probably one of the most exciting years for unicorns rolling onto the public markets. So I just wanted to talk a little bit about that. I think it's exciting because I think it's important for investors to learn, why a company might go public, how to look and to really research if it's an investment, and if not, when they roll public, when. It's good for financial literacy to be engaged in a product that some of the ones that have rolled on. You probably use Uber quite a lot. That's come on this year, amongst a number of others. So we'll talk about a few of them. But 2019 has been a banner year thus far. The first half of 2019 saw more proceeds raised than any other year, which is really interesting, more than the tech bubble. So we'll get to that in a minute. And as we see more and more roll on in the second half of 2019, it probably will surpass the tech bubble, and over $100 billion is going to be raised on the public markets for these companies. So why do I care? Well, I mean, we're investors, and so we're investing. For the most of us are retail investors, and we're investing in companies, or baskets of companies, exchange traded funds or managed funds or whatever, that are publicly listed. That's what we have access to as retail investors. Now, a company has to go obviously from a private state to a public state, and they do that in an initial public offering. So that's an IPO. And I just want to talk a little bit about what that is. So an IPO, again, is when a company decides that they want to sell their shares publicly, and they do it for a number of reasons. They do it, and it's important, this distinction between IPO and direct listing. And I'll talk about someone that direct listed this year, actually. But an IPO, they would IPO to raise funds. That's probably the most obvious one. So they've got already, they've been able to raise money privately, but they probably need deeper pools of money. So they're looking to do that on the public markets. They do it for prestige. They do it for awareness. They do it just because it's the thing to do at that size. If we look at the IPOs that are listing this year and the glut of them, it's because they're about 8 to 10 years old. So these are these startups that we were using, kind of eight 8 to 10 years ago, or made aware of, and they've gotten to a size now and a valuation that's kind of the next obvious step. Now, so with an IPO, you would go through a process where you get an underwriter, and that's probably an investment bank, and it costs a lot of money, because what they do is they shop you around and they get everyone really excited about your share, that's about your company that's about to be listed. They get investors excited. They get, they form your prospectus, which is basically a business paper that talks about who your company is, how you're going to make money, the risks and the opportunities of the business, and they get people really excited about that. And then when they help facilitate the actual process of getting it on to one of the share markets, let's say NYSE, the New York Stock Exchange, and then they help set the price. So there's a secondary market that happens the night before, and that's kind of this trading stuff that happens between institutional investors, banks, and VCs, and that's where money is changing hands. And in a way, they're establishing the price of that IPO. So there's kind of a set price that they think based on evaluation of the public market, but then there's the secondary market that trading takes place. So by the time the stock hits the open market, you've got a price, but it's not necessarily what the indicated price was at, because all the tradings happened the night before. So that's not always a good thing, because a lot of kind of those initial gains can happen where everyday investors like us don't get access to that. Hence the direct listing, which is interesting. Direct listing is something that Spotify did and what Slack did this year. For any of those that are familiar with Slack, probably have used it or know someone that has used it. And now a company that does a direct listing has decided we don't need funds. So we're going to list, because another reason why people list is because their employees have now worked for their businesses for 7 to 10 years, want to get, or the VCs want to get some of their money back. They've probably got they've got some stock options, they've got some equity, and the only way to get out of that, of course, is to sell those shares and on the public market. So the direct listing is for that purpose. When you do a direct listing, you don't issue new shares. So it's not like an IPO where you're issuing new shares. You're basically selling those that are holding existing shares on the open market. So it can be a little riskier though, because it's also much cheaper because you don't have an investment bank or an underwriter that's shopping you around, that's kind of guaranteeing the sale of your shares. So when they hit the market, it can take a little longer for them to actually hit the market and for us to get access to them. But when they do, they can be volatile. Now, we didn't see that with Slack and Spotify. But again, it kind of limits people that do it, because you have to have a really recognizable brand and you have to have liquidity, which means you have to have a lot of buyers. They're going to want to buy the shares. So Slack, was quite an interesting case. We were up at 2 a.m. kind of waiting for it to roll onto the Hatch platform, and hundreds of people were on there waiting for it to come on. And unfortunately, it didn't come on until about 5 a.m. So we kept getting pinged, when's it coming? When's it coming? So anyway, Slack was quite an interesting learning experience from a direct listing. Now, I don't think it's going to become the way of private companies going public, because it's a little bit riskier. You have to check those boxes of being really well known, having a huge base of buyers ready to buy your shares. But also you're doing it when you don't need the money, because you're just selling existing shares. But Airbnb is actually rumored to be looking at direct listings. So that'll be really interesting when that comes up. So let's look at a few IPOs that happened this year, some that I'm sure you've heard about that are available on Hatch. So we've got Uber. Now, Uber and Lyft, these are now becoming known for some of the kind of most unsuccessful IPOs of this year. Lackluster IPO is how people describe them. And it's interesting, we're seeing now with WeWork, and if you haven't heard of the big controversies of WeWork, I'm happy to fill you in. But what we've got these companies that are valued at enormous amounts of money, like mind-boggling amounts that these companies are valued at. And you just think, well, of course, because I use Uber every day. But they're losing an enormous amount of money. And a retail investor isn't as forgiving with a company that's losing money as a VC is. So with a VC, it's, SoftBank pours money into these companies because it's grow at all costs. It doesn't matter if you're losing buckets of money, because you're gaining market share and you're, expanding your footprint and you're going global. And that's fine, because that's what VCs want to see. But public retail investors, not so much, not so sure. So when these companies came on, really high valuations, losing a lot of money, the markets have spoken. And so these have been really interesting IPOs this year that I think have been a bit of a wake-up call. And the final nail in the coffin of this kind of valuation and fundamental worth is WeWork. Now, if you haven't heard of the WeWork drama, has anyone heard about WeWork? What's happening there? Shared working space put out their prospectus. Again, that's the business plan they put out to all the investors. They say this is what our company is about. Anyway, it made no sense to anybody. There was very strange language in it. It talked about, we're not a real estate company. I think they used the word tech 123 times in their prospectus. Things like we're not real estate, but we're about raising world consciousness. I mean, it was absolute garbage, this prospectus, and the entire investment community. And now they're saying you're valued at $47 billion. You're losing tons of money, which we can see in this thing now. Absolute rubbish. And so they were slammed in the media over the last 2 weeks. And it's been really interesting to watch because people are pointing to Uber and Lyft and saying, see, you can't do this when you go public because we don't want to invest in companies like you that are a bit smoke and mirrors, and just felt very strange. And so they've been slammed. And not only did their prospectus have kind of all this weird, vision stuff, but had some really weird governance structures, because you also, of course, have to disclose that. And it basically had their CEO being able to make all the calls and having a 3-share structure in which he could always maintain a huge amount of control, which again, investors don't feel very comfortable with. So they've had to rewind and kind of slash their valuation to now kind of 20 billion. People are talking now 15 billion. So their share price, which would have gone out at a certain amount, has now been halved. And you can imagine SoftBank, one of the major investors in this company, going, hang on a sec, we now have to write this business down if you go public, because you were worth 47 and now you're worth 15. This is crazy. So very interesting to watch. A bit of a reckoning day for investors, and good for buyers, because what it means is that people are pushing back and they hit the wall, and they've kind of found that wall, and they said, we need this to make sense. So now SoftBank is kind of wanting them to shelve the IPO, but they need money. And that's why they were IPOing in the first place. So stay tuned, watch this space for WeWork, pretty interesting. Zoom and CrowdStrike, 2 that came on a couple months ago, I think March. And you can see that, sorry, this is 62 is what they came on at the IPO'd at, and this was their price as of market close today. So green, good, they're in the green at the moment. They've both done well. Why? Well, Zoom launched when it was profitable. So lucky them. Investors love profitable businesses that are growing. So Zoom is doing quite well on the markets. CrowdStrike, same thing, not profitable, but doing well. But interestingly, both of these are B2B, and B2B companies, tend to do well on the market, and actually for VCs as well, because businesses are a touch more predictable than consumers. So here, these are 2 IPOs that are doing quite well. Zoom is video conferencing. If anyone's ever used video conferencing, you know how shite it is. And like someone who solves that is probably, pretty interesting to look under the hood. CrowdStrike is security. So it's a cloud-based security firm. So again, that's an interesting space. We get that as, people who are familiar with technology. Another 2, I talked a little bit about Slack. Again, a company that is growing well and is gaining users well, but is also losing quite a bit of money. So they've been struggling a little bit with their share price for that reason. I think their losses, people are questioning. They know that competitors are in this space. For those that use Microsoft Teams or other chat, it's getting to be a bit of a crowded space. And so Slack has been a bit of an interesting one. Pinterest is doing well. Pretty niche market. I imagine probably only half of this room uses Pinterest, but nonetheless, the market seems to like what they're doing and responds favorably to their share price since they've IPO'd. Chewy is a pet is in the pet market, as the name would imply, and look, they've actually done all right. They've been kind of up and down, and Chewy's an interesting to watch because the pet We treat our pets like children now. For anyone who has pets, you kind of get this. I think it's an industry that's due to be $250 billion industry by 2025. We spend a lot of money on our pets here in New Zealand as well. So that's a pretty interesting company to watch. Beyond Meat. Who's heard of Beyond Meat? Yeah, that's a pretty interesting one to watch. Yeah, Jeff doesn't like this one. He doesn't get it. I get Beyond Meat, but this I don't get. This is crazy. I mean, some of the price from IPO shot up over 600%. So we've got some hatch investors that are pretty happy with Beyond Meat. I think some of it is, analysts say some of it is emotion. Like, it's not necessarily the fundamentals of the company, because they are losing money. They're growing quite well, though. I mean, their sales are great. They've got some really big deals penned. I think it's probably a little bit of that first mover advantage, isn't it? Like, there's no one else that's publicly listed that you can get into at the moment. But they've also got some pretty big established competitors on their heels. So interesting one, Beyond Meat, that people are watching. So some findings. This is actually, I just wanted to talk a little bit about the IPO findings. Now, the IPO market, well, I showed you some good, some bad, some ugly in those companies. Generally speaking, the basket of IPOs is really favorable this year. So I think there's a IPO ETF that I'm actually requesting to get rolled onto Hatch, just so you don't have to, put your hopes on one IPO, but you can actually invest in a basket of them. That's actually up 32% this year. S&P 500 is up about 13 to 15%. So that's the IPO basket is doing really well. Now, I have to say, probably three of those biggest movers in that ETF include Beyond Meat, which is helpful. They include Zoom, which is helpful. And then the third one is a Shockwave, and it's a medical company that's also doing really well. And they create, I think, pacemaker kind of devices and AI. So very interesting as well. But the broader IPO market is performing really well. So it's an interesting year. This is different than tech bubble. I do get asked, is this just like the tech bubble, this IPO craziness bonanza? And it is different because, again, if you remember at the beginning, I talked about companies that were about 7 to 10 years old. The tech bubble, when that went live, those companies, some of them were not even a year old, and they were launching on the public market. Like, it was absolute insanity. So I think there's kind of some more rational behavior happening here with this market. It is different. Goldman Sachs looked at over 5,000 IPOs over the last 25 years, and they kind of came up with 5 factors what can make or break a newly listed company. The first is sector. So if you look back at that tech bubble, probably 100% were tech, obviously. There's only about 19% of tech is represented in this IPO market now. So there's healthcare, like, it's well diversified. So sector and what sector you're in. Company age, again, I talked about that a little bit. Initially, how established are you? How much pattern of growth do you have? Valuation, of course, investors don't like really high valuations that don't match up with the fundamentals of the company. So that's an important one to look at when companies are IPOing. Path to profitability. Again, there's patience. When a company is losing money, I think retail investors have patience as long as they can understand there is a bit of a okay, we recognize they're not profitable now, but it's because they're expanding their footprint or they're sacrificing it for growth. And we know that for Xero, we happen to be in this building. We know that for years, people didn't understand why they weren't making money. And it was this kind of land grab situation that they had to spend in order to do so. But if you can recognize the path and see that, that's investors like that. And finally, sales growth. I mean, that's a no-brainer. Those that have, increasing sales growth, Beyond Meat, for example, all of these companies, investors tend to like that and reward that when companies are public. Investing tips. Read the SEC form. That's really important to actually read the prospectus when you're looking at investing in a company. It can be a bit dry, but again, it's the only information you have because, again, these companies haven't been around. They're not analyzed by strategists, and so it's the only information you can find on companies. How they're making money, what they're about, what their plans are, the risks and opportunities. Check the lockup period. It's something I didn't talk about earlier, but the lockup period is basically the time where the inside investors, so the employees, the VCs, they're not allowed to trade. So on a direct listing, of course, they trade right away. That's what they're looking to do. In an IPO, there's usually anywhere between 3 months and 2 years where they're not allowed to trade. Most is about 6 months. So watch for when that lockup period is, because that usually, you're watching very closely, it's usually kind of an escalated period of trading around that time. And if you see some of the inside investors dumping a lot of their shares, you might, it rocks a lot of investors' confidence in the company. So it's something to recognize when that is. And fear of missing out, just don't do it. I mean, I think IPOs is something to be skepticism is probably a very good trait to have while you're watching these IPOs come out. A healthy dose of conservatism, there's nothing wrong with that. And just kind of, not lose your head about the fundamentals of investing and kind of what makes sense and what works for your strategy. So keep calm and invest on there. I want to talk a little bit about Hatch now and how we're learning from one another. And so this is our Hatch Investors Club. And as I said, we're working with our community to build out our platform. And we're learning some really cool things, and not only the benefits of Hatch and all of the companies and ETFs that you can access, but you can also access some really smart investors as well, some of whom are in this room. And so when you become an investor, you get invited to an investors club, and it's an amazing space where people are talking about their strategies, they're asking for advice, they're asking what books to read, and they're learning from one another. And we just think this was kind of the Facebook group, recognizing not everyone's on Facebook. This was kind of our first MVP, minimum viable kind of test of saying we think investors want to talk to each other and we think they want to learn from one another much more potentially than going to an advisor or someone they don't trust. And so this is a test, and it's going really well. And we're learning a lot from our investors as well, which is super cool. Second place, and Jeff's actually in the room. Sorry, Jeff, not to embarrass you. But we're learning directly from our investors. And they're willing to share their strategies, their philosophies, and we're sharing that back to our Hatch community. So if you go on and check out our blog, you'll see everyone from adventurers to travelers to professionals to freelancers that are investing, and they're willing to share who they are, a little bit about who they are, why they're investing, their investing philosophies. And so feel free to check our blog out for that. We're learning a lot about them. And what we did with, once we kind of started to learn about what our investors are doing, but also look at our data, we're kind of, recognizing some trends in our investors. And I just want to share kind of some of the different types of investors we get on the platform. So the first is the newcomer. So we get someone that comes on. We didn't actually launch the platform for new investors. It's not something we had anticipated. But we are finding that people are trying investing for the first time on Hatch, and so it's important that we provide the right information and not advice, of course, but we get them comfortable with what they're doing. So we find these newcomers come on, and when we think about it, while exchange-traded funds are a fantastic way to start, easy way to diversify, investing a limited amount of money in a share is also a fantastic way to learn. So if you were to say, look, $500, $1,000, this is my investment education, chalk it up to that, put it into one share. Now watch what that share does over 12 months. I mean, that's a learning experience. You can see everything from what the share does over earnings reports. They release these reports 4 times a year. And you learn what that does, the market does to that. You can learn what it does with economic things like the China US trade tensions. I mean, that affects Apple, of course, because they're selling into China, and a number of other firms, of course. You can see what happens when Trump tweets. I mean, wow, that has an insane impact on the US markets and our shares, which is quite interesting. So this financial kind of this education that some of our newcomers are getting just by kind of dipping their toe in and learning has been really interesting to watch. The second is the passive investor. Again, we didn't anticipate that. That's this dollar cost averaging, those that want to put small regular amounts in. We didn't set up the business model to be that way. We'll admit that, but we're looking at ways to do that. But we are, and also an auto invest feature. But we are learning that people do want to do that. Just kind of set and forget. Just set a certain amount in to a couple exchange traded funds, and that's that. And that's as much as they want to do. So that's pretty interesting. And then we kind of get these active investor groups who we knew we'd get. We get the value investor. The most famous value investor of all time, Warren Buffett. So he was looking for shares for companies that were priced under what they were actually valued at. and he would buy in at that and make a ton of money. And he's done very well on that. So he would look at all the fundamentals and do all the analysis, and he would recognize that the share price, was valued less than actually what the company was worth. As such, he knew over time the share price would go up, and that it did. Now, I'm sure he's made some bad calls in his life, but he's done pretty well. So we do have value investors on Hatch that spend a lot of time, learning about particular companies and kind of getting in and looking to profit from those. We've got Core Satellite. That's what I'd consider Jeff. And that's pretty intense investor. That's someone that kind of builds their core, like 50% of their investment is predominantly really common ETFs. So like large market cap ETFs or an S&P 500. And that's kind of their passive piece, boring as you might say. And then they go and have a really active strategy to try and beat the market. So they might, really feel as though emerging markets is somewhere to go and kind of build these satellite funds outside. So they'd invest in potentially emerging markets, ETF, or they might invest in some tech companies or some real estate, and they'd actually try and make the smart portfolio, which is pretty interesting. And the last one is growth, and I think that's very obvious. I mean, growth stocks are those that have significant growth. They tend to be those that are some of our most popular stocks. Those are technology. They're microprocessors, the NVIDIAs, the AMDs. They're those companies that are kind of really at the forefront of what they're doing and kind of market leading. So it might be the Teslas, it might be, these companies that are quite volatile. So no doubt there's lots of ups and downs with growth, but over time, the expectation is that they are going to grow significantly. And Amazon would be a perfect example of a growth stock, at where it was priced at, even 5 years ago to where it is now. Whoever held that probably is doing quite well now. So that's those kind of the investors that we've got on Hatch. So it's really varied, and that's been quite interesting for us to learn. We look forward to learning more. And like I said, we're almost celebrating our 1-year anniversary, and hopefully next year we'll have lots of cool stuff coming out on the platform as well. But I'm happy to take any questions that you've got now, and we'll go from there, shall we?
So a few things I think that we should just cover is the fees, fee structure. Maybe you want to talk a little bit about, I've heard you guys advertising about mistakes. Yeah. And then maybe about picking and researching, how do people decide, yep, I'm going to research and then I'm going to choose to invest in this stock.
Good. Okay, I have to bring up this mistakes blog because I sometimes forget the fourth one. So give me a minute. Pricing, we'll talk about that because that's easy. So what we've started with is a traditional brokerage model. When you buy or sell a fraction of a share, so you can actually buy, you can put $300 into Amazon. You can buy a, portion of a Nike share, and ETFs not so much because they're priced, between $30 and $50. So you probably wouldn't do a fraction of an exchange traded fund. But you would certainly do a fraction of Amazon, which is priced at about $2,000. That will cost you $3 USD. So you deposit your money into our New Zealand bank account. We then push all of our, for now, we push all of our money across in NZD. We work with a foreign exchange service that changes your money into USD, and it lands in your Hatch account the next day, assuming you give it to us before 2 p.m. on a business day. It'll land in your Hatch account in USD the next day. We put a 50 basis point charge on top of the exchange rate. So that's very competitive. Banks would probably be double, if not triple that. So really competitive, just small clip of the ticket as your money goes over. You wake up, you can do your thing. And as I said, a fractional share will cost you $3 to buy or sell, and a whole share will cost you $8 USD. So I mean, comparing that to like right now, if you were to use ASB, it probably cost you $90 to do the same thing. So we were trying to keep our fees low by leveraging technology. And again, we did factor, people putting kind of investing lump sums in, which is why that pricing model is where it's at. And we've done so well so far with our current investors, but certainly open to looking at some other models in the future. In terms of the mistakes, we actually went out to our Hatch Investors Club and we asked what their mistakes were, got all sorts of feedback back, and I want to talk about the 5. So following the herd, That's that everyone's like really excited about a certain share or a certain thing. Cannabis is probably a good example of that, and just getting into it just because. So that's a mistake that people have talked about, getting kind of wrapped up in the hype and maybe not really looking under the hood of the company or thinking about, well, what, does this make sense? And does it fit with my investment philosophy or strategy? Not doing the research. So that's not looking at, the biggest recommendation that we made was the annual report. The annual report will tell you a lot, and that's like the prospectus. Just learn about the business. If you're investing in a company, you're buying a piece of that company. Think of it like that. Think of it, would you buy this business with your money? So is it making money? If not, why? What are their plans? What are their revenue models? SaaS is really exciting. SaaS is subscription as a service. And so some of the IPOs that are coming up this year are Peloton. And that's a good example of a SaaS company. And so it's reoccurring revenue. You know that this revenue is coming in every month. Netflix is a SaaS company. So again, these companies are making revenue every month. It's quite predictable. So it's quite easy to analyze companies and their annual reports. The third one is active trading. This is something that a lot of new investors think, oh, I'm going to, time the market, and I'm basically going to get in and I'm going to get out and I'm going to become a day trader. Studies have shown that people don't win. I mean, they can't beat the market. And so again, it's kind of setting your strategy, setting your timeline, and then just sticking to that strategy. Guided by emotions, we talked about that a little bit. When the markets freak out, you shouldn't. Because things happen, like Trump tweets and things happen, and you shouldn't pull out, particularly when you're down. So, or you should actually think twice about that at least, and really think about what you're doing. And the final one's not starting sooner. That's just getting started. And actually, people regret not starting investing sooner, because of course, over time, you're building wealth, and that's really important to get started today if you haven't. And then the other thing was, I certainly, people do it in different ways, research and picking. I think if you don't want to do huge amounts of research and picking, that's why exchange traded funds are interesting. So do you want to maybe try and investing in the top 500 companies in the United States, then put some money into the S&P 500? Do you like technology and want to invest in that space? Then you might look at a couple exchange traded funds that are have tech companies inside of them, or follow, for example, the NASDAQ 100. You might have advisors. You might look to get advice and just execute. You might have a peer group that you're like analyzing with, but probably exchange traded funds are a pretty easy way to start, so that you don't actually have to dive into the fundamentals of a company. Unless, like I said, you know a company really well. A place to get started is something that you know well, and that you feel comfortable. It's like, yeah. So again, like, look around you, look at the trends that are happening, look at what the youth of today are doing. I mean, these are interesting. Look at healthcare. I mean, that's aging population. There's kind of sectors that you can narrow in on and learn about. You don't necessarily have to start and know everything initially. How about questions? Any questions from the crowd?
Are you planning to have credit card to kind of fund your account at any time soon?
It's funny, we get asked for credit card, and we tested it in the prototype. And then when we told people about the interest and how that, your interest and fees erode your returns, and when we kind of explained that to people, they were like, yeah, never mind. And so we're reluctant to get credit card. And so we always dig deeper to what is the problem you're looking to solve. Like, why would you use a credit card? Do you want faster deposits? So I think rather than say we're going to do credit card, I think we would kind of tackle what's that problem. And if it's faster, there's other ways we can do that. And there's other funding mechanisms we can look at that actually won't cost you money to do so, or might, so I'm not going to say yes or no, but certainly we're open to discussing, what you're looking to solve.
Can you please tell us a little bit about how the US tax works?
Yes, yeah, tax. So when we first started looking, the barriers to entry were why people weren't investing in the US share markets was cost and the FAF to do it. So we removed the cost barrier and we removed the FAF. You don't have to get on the phone to a broker while the markets are open. It's like I said, you can place your order in Hatch, and if the markets aren't open, it just gets executed at market open. So we've done that, but we recognize that tax is also a pretty scary thing for people. So if you're investing under 50,000 in foreign investments, so if your investment portfolio is again under 50K outside of New Zealand, not just on Hatch, but all of your investments, tax is the same as anything here in New Zealand. We give you one number at the end of the year, and that goes in and that's from your dividends. So you get taxed on your dividends. The same with the US shares, just as you would here. You put that number in your IR3 and you're done. With respect to withholding tax in the US, when you sign up to Hatch, we submit a W-8 BEN form on your behalf saying you're a non-foreign resident, and they grab it at the other end. And so it's kind of taken care of, but then you get to claim back those credits, particularly if you're over 50K, you get to do that. So under 50K is super simple. We've completely just made that really simple. If you've got over 50K, it's a bit more complicated in foreign investments, and because there's different ways of calculating and figuring out the amount of tax that you have to pay back here in New Zealand. So with those people, some of them have accountants, and those that don't, we've connected with ShareSite, so that ShareSite can figure out those calculations for you. So they figure out the calculation based on your portfolio, and you simply just pay your tax at tax time. So we think it's pretty simple, and that we've removed that barrier. But certainly if you're under 50K, we've removed it.
Okay, so have you got any timeline to actually have an app, Android, iOS?
Yeah, we get asked for an app lots, and we say just download the icon on your home screen for now, because if we do an app, what it means is it's opportunity cost of doing other cool things. And so we will do an app eventually, but again, it's like, what's the problem we're trying to solve? If it's you want an icon on your home screen, you can do that. If it's the logging in, because that can be a bit more of a pain, we can maybe look at fixing that. We can look at that, but the app itself, I think for the experience of you as a user with the app, which is probably notifications, to be fair, that's probably the biggest advantage to an app. We just think that the opportunity cost of doing something else really cool on the platform right now is not worth it. So when we explain that to people, they're like, yeah, it makes sense. Because we're only having to kind of build cool stuff on one platform right now, whereas if you have an app, you've got to do 3, and then it just slows you down. So right now we're kind of looking at building really cool stuff, and then we'll do an app.
Will you be looking at relationships into other countries, or is it just the US for now?
Yeah, well, we started it with the US because we knew that if people invest overseas, 70% of their overseas investments are in the US. So that's a no-brainer. We also have ADRs on the platform. So the big foreign companies, like Alibaba, for example, Neo, those are all listed as ADRs, which is American Depository Receipt. And they basically are listed on the US share markets through an investment bank, and you can access those via Hatch. So that kind of ticks some of the big foreign ones, but recognize that we do get asked for, ASX is a common one, as is China, or depending on what's going on in the world, people ask for that. So certainly what we do is we collect feature requests and then prioritize them based on what would solve the most problems for people, or what's the most sought after thing. So for right now, it's features on US, and then certainly looking at other markets as well.
Thank you. Can you tell us a little bit about the cool stuff that you said is coming up?
Yeah, well, we know we need to do stop loss orders. We know we need to, what are some of the other things we have to do? Oh my gosh, I could open our Trello. We basically have like hundreds of feature requests in Trello. We're launching auto invest probably sooner rather than later. And you can basically, the minute you're Hatch, you can kind of preset ordering, like say when my account hits $500, throw it into this exchange traded fund or into Tesla or whatever. So we'll be launching that soonish. We're also doing categorization because we recognize that for those newcomers that I talked about, they're overwhelmed when they first open Hatch because it's like, where do I even get started? So we thought kind of grouping some of the shares in categories, again, those areas that they recognize and they're familiar with would be a really good start. So we've got categorization coming out next week, or the start of that. Like I said, stop loss, looking at, I don't know, I mean, maybe model portfolios is kind of interesting. Again, people that are like, what might it look like to build? They kind of just want to replicate a portfolio. So that's something we're looking at. So yeah, there's lots of kind of ideas, and it's not until we kind of hit the top 3 that we fully flesh them out. And so yeah, sorry, lots coming, but those are kind of the next ones up.
Are DRIPs coming soon, and how did the meeting with Drive Wealth go?
So
recently?
Drive Wealth is coming next week. We're leaving next. We don't leave tomorrow, but next Friday. I don't think they're going to do drip. I don't think they're going to do drip. So what we'll solve that with is we'll have another product on the platform that will do it. The US is just the first of, we hope, many cool things on the Hatch platform. And if the broker's not willing to do drip for it, we'll figure out why. Who are you, by the way?
Robert Ing.
Oh, hi, how are you? So funny meeting investors face to face. Very cool. I won't promise drip. I don't know why, but what I'll learn is why they won't do it, and then we'll just solve the problem a different way.
What's your background, and how did you get into creating Hatch?
So my background is, in New Zealand, it was in the digital space and then startup space. So I'm like really familiar with co-working spaces like this, and we work ironically, and it was really just kind of scaling startups, and predominantly overseas, not here. But also was in the startup space since moving to New Zealand. And then I was introduced to kind of fintech and financial technology, and it really resonated with me because my personal story is that as a female being raised, I was never taught about investing, about how to manage my finances. There were no cool budgeting apps. Even today, I'm still annoyed that the banks haven't moved quickly enough on actually helping us with our finances. It's very passive here. You kind of have to sort it out yourself in an Excel sheet or a whatever. I wasn't taught about investing, so I went in quite green in my 20s and basically gave my money to someone, probably paid an insane amount in fees to do that. And he got kickbacks probably on the products that I got put into. So for me, it was when I was introduced to this idea of financial technology and that it's disrupting. I love disruption because that makes me angry, that stuff. Paying too much and being ripped off and taken advantage of, or not putting the customer at the center. And that's what I find so cool about startups, is that they're so customer centric. And that's why Hatch is so passionate about that, putting the investor at the center and like really deep diving into how do we solve their problems as opposed to kind of incumbent motivators, not suggesting all are, but so financial technology, I just got really into that, and investing was a big one of me, personal financial management and banking, and so all that kind of stuff was of personal interest to me. So when I was approached to do, to disrupt this space, I'm totally game. I'm all for it.
It's awesome stuff, really impressive. What would you say your biggest risks are?
Biggest risks of?
Risks
of investing? Of
No, the biggest risks for Hatch.
The biggest risks for Hatch. Gosh, we're a really interesting. New Zealand's funny because I've been in the startup space in New Zealand, and New Zealand's tiny. And when you're a startup, you need growth, of course, because people are investing in growth, and that's a very hard thing to do in a small country. But how interesting that we're in a position that's backed by the Kiwi group, which is all about putting Kiwis first. And so we've been fortunate enough to be funded by Kiwi Wealth. And so we've got a significant backer that's backing not only in the well-being of Kiwis, but also is really interested in positioning themselves for the future and being relevant. And as I said, that rise of self-directed investing and getting younger, people engaged with their finances, all those things is of interest to them. So Hatch somewhat is protected by the normal risks I would say a startup that I've experienced in the past is exposed to in New Zealand, where you're on a plane all the time to the States. That's not something we need to worry about. And so I'd suggest biggest risks are gosh. I can't think of any big risks at the moment because I mean, gosh, we did 6 months of due diligence on our partners. You know, we've been so thorough and we care deeply about, you know, our customers' money and you know, this platform and the longevity of it. So I think maybe it's pressures we put on ourselves, and that's growth. And we would just, you know, every day it's like, how do we get more people to hear about us and to love us and to grow and develop the product? So for me, that I guess maybe not a risk, but a frustration is it's, you know, we're not moving fast enough and you know, growing fast enough. But we are. Things are going really cool. But that's just pressure we put on ourselves, I think. Didn't really answer that question, but it's a tough one.
You dodged it.
What do you think the risks are? I don't know.
It's like going for a job interview. What's your biggest strength? I just work too hard.
My biggest strength. Oh, that's terrible.
So before I let you go,
She threw me. I'll have to think about that now.
before I let you go, 10-second answers only. What's two to three stocks that are coming up that you think people it's worth looking at?
For IPOs?
For IPOs in the next 6 months.
Yep. Okay. 10 seconds. You can't say stuff like that because then I get all stressed out.
You don't have to justify
Let's watch
it.
WeWork because that'll be so interesting. If they actually come onto the market, they'll probably have to make sense for investors. So let's watch WeWork and let's watch Palantir because that's like this top secret company that's coming on and no one knows anything about them.
That's Peter Thiel's company, right?
Yes.
Yeah,
And
so Peter Thiel was the first institutional money into Facebook.
Yep.
It's a very good book called Conspiracy about Peter Thiel. It's worth your time.
So Palantir's coming on this year. So wow, we get to learn about that company.
I'll let you get away with two. So I got a couple of things after we let Kristen go, but let's just give her a big round of applause. I'm sure she'll hang around. Thanks very much. You're not going anywhere, right? Yeah. So yeah, look, I was talking to a friend of mine that works at a pretty big company, and he was saying that he saw recently that one of the banks was helping a deceased estate manage their money over $6 million. And basically they'd packaged up a Vanguard fund, and they were charging their 2% on top of a packaged up Vanguard fund. And I thought that sort of thing should be illegal first. And I can't believe a bank would get away with that. But it just reminds you that you really got to be responsible for your own money. And I really do believe that Hatch is a platform worth checking out because you know, got the low fees, but because of the backing and you can watch Kristen talk. She's passionate about it, and you feel like you can trust her. So, which is not something that you can say about a lot of people that are pushing products. For Auckland Investment Club, we're thinking we'll probably run another event before the end of the year, maybe two. So just by a show of hands quickly, who would be interested in property investment side of things? All right, good number. If we do something along small business, you know, buying and starting your own business side of things, show of hands. Sweet, okay. All right, just before I go, I'd like to recommend a book. So Leighton that spoke, one of the Sharesies co-founders last time, we've been talking a little bit online, and he recommended a book by a guy, Chris Lee, that Chris Lee runs over $1 billion of managed funds down the line a bit, I think in Timaru or Paraparaumu Beach. So he looks after quite a bit of money for small to medium investors, and he wrote a book called $1 Billion Bonfire. And the book is about the South Canterbury finance collapse and just how the government handled it, and how the receivers handled it, and how a lot of money was lost. And the lessons that I took away from that book, it is a lengthy book, but I thoroughly enjoyed it, is that you really got to be responsible for who you choose to run your money. And if you're going to run your own money, then you've got to put that own responsibility on yourself. But if you're choosing someone to look after your money for you, you really got to do the due diligence. You can't just say, well, I really trust that guy or that lady that I'll just let them run my money, because Alan Hubbard was a trusted figure, and he, they still probably think he should have been knighted down in Timaru, but the investment decisions they made were absolutely ridiculous towards the end. Funny story. There's two funny stories. One, the Lord of the Rings guys came to him before they made the movies and asked for $30 million. And the way the movie market works is all the creators get their money out first. And even though lots of money was made in the Lord of the Rings, that $30 million that South Canterbury Finance put into that movie series, never ever did they get a dollar back. It was a poor investment. They took advantage of a guy that thought, oh, yeah, I can back these guys. And so the guy, Alan Hubbard, was running $1 billion, and he still made a stupid $30 million decision like that. So you just got to always be thinking, is the person that's looking after my money in the know? And another funny story from the book is there was a run on the bank in Timaru. And back in the day, they thought that BNZ was going to run out of money. So everybody was lining up outside the bank. They wanted to draw their cash out. And so what Alan Hubbard did is he walked up and down this line. People were walking in and out of the bank. Their pockets were full of money. And he said, why don't you bring your money down to me, South Canterbury Finance? I'll look after it for you. And of course, because Alan had been such a successful investor for so long in Timaru, they all walked down to South Canterbury Finance and gave them their money. And at the end of the day, he took all that money and he deposited it back at a BNZ account. And he became the biggest depositor in Timaru with all the banks. And it just goes to show you that if you follow the herd, like the first mistake, sometimes you can make pretty silly decisions. And there's a lot of people in Timaru and those areas that are still hurting for the money they lost. So Chris Lee and Partners is the firm. I recommend his book and I recommend his newsletter. It's very good about the IPO stuff, and he can rub you. He has a lot of enemies in the space because he tells it like it is. So that's a good book. So if you got questions, Kristen, hang around. If you want, fire an email, andrew@aic.co.nz. Love to get feedback on tonight and what you guys want to see in the future. Thanks very much. And one last thing, make sure you have another drink and some pizza, otherwise I got to take it. Don't be shy.